Hey all, welcome to ShareTreck. This is Raj here, friends. This is the next episode of our technical analysis series. This is the fourth one. And today I'm going to talk a little bit about patterns. Of course, there are a few more trends that I want to talk to you about, like exponential and simple moving averages. But I'm sure that you're raring to go with trying to find some predictions, some chart patterns. So today we'll do a couple of chart patterns. And then we'll get back in the next session to talk about moving averages and other trend lines. So let me take you to the TradingView platform and walk you through these. I'm going to start with my favorite stock, which is NVIDIA. And here you have a cup and handle pattern. So how do I decide a cup and handle? Let me delete this for now so that I can show you what it looks like. So over a period of time, which is more than a week, we observe the price trend, and if the price trend dips and then comes back up again, and if the two ends of that dip are almost equivalent, then I would like to draw a cup where the neckline is basically the line that connects the topmost price of that cup formation on the two sides. So that becomes the neckline. And then next what I'm looking for is a little bit of a dip and then an improvement in the price for that stock, which kind of forms a handle. So this is the handle out here. And what it shows us is that there is a potential price target. To determine the price target, we take a line from the lowest point of the price within the cup and draw it all the way up to the neckline, and we copy the same length of line and put it above the neckline, and the point where it ends is the target price. And in this case it ended up on a support line, which is this green line, and it was 545.41, and it took it more than a week to reach that target, and then it surpassed the target and went further ahead. So this is the example of a cup and handle pattern. So to repeat the whole thing again, identify a pattern which dips like a saucer and comes back up, or which dips like a valley and comes back up, and then draw a line which is connecting the topmost points in that valley or in that cup, and that is your neckline. And then take the lowest point of the price within that formation and draw it all the way to the neckline and copy the same length of line and place it above the neckline, and that will give you the target price. However, a cup and handle pattern has to be formed over a period of weeks, not days. So once we have a period of weeks, then the cup and handle pattern is good. And then after the cup is formed, there should be a dip in the price and then a pickup in the price, and that's where the handle forms. Now in this case, this I would consider to be the handle, and then since then the price started going up, it met our price target. Now the next formation I want to talk to you about is that we already learned about the bull channel. So this is a bullish trend. So if we have a bullish trend, for example, this is a bullish trend out here, and when we have a bullish trend, if we have sideways movement of share price, then we try to connect all the top points of the candles and then draw a line which becomes a line of resistance, and then we connect all the bottom points of the candles and draw a line which becomes the support line, and this is called as a bullish pennant. And in this bullish pennant, what we are looking for is for the price to break out on the upside and move upwards. So this is more of a consolidation of a bull run where people are getting accustomed to the new high price, and then the next leg up comes in. So that's how I look at it. And just like the bullish pennant, we also can have a bearish pennant, and bearish pennant will always break down on the lower side. So bearish pennants are always formed on the downward progressing bear channels. So I'll find an example of that and show it to you. Here is another example of a cup and handle pattern. It is in Qualcomm. So this valley out here is the cup. So I have connected the topmost points of the two ends of this valley. That forms the neckline, and the arc that is formed to connect these two and encompass this valley is the cup. And then we have a pronounced handle which came down and then picked up, and our target was creating a line from the bottom of the valley where the lowest price is found all the way to the neckline and duplicating the length of this line and placing it above the neckline. It gave us a target of 175.74, and Qualcomm achieved the target, and then started coming down. So this is another good example of a cup and handle pattern coming true. Here's yet another cup and handle pattern still in play. And I don't know if the target will be achieved, but this is the chart for Meta. And Meta has formed a huge cup and handle pattern out here. If you can see, we have a very big cup, and we have a nice handle out here. And since then the price has been going up, we are looking at a target price here of around 544.03 for Meta. I'm not sure if we can achieve that target, but we have done close to it. So this is another example of successfully spotting a cup and handle pattern. Here's another example of cup and handle pattern with ASML. So ASML formed a cup and handle pattern out here, and we plotted the price target using the lowest point of the price within this formation, drawing it all the way up to the neckline, and then replicating this length of line and placing it on top of the neckline. And that gave us a target of 949.80, which was met and achieved by ASML. And now we are on our way back down again. So cup and handle pattern work a lot, but there are times when cup and handle pattern may not happen, because even though technically it is supposed to happen, there could be a geopolitical event, or there could be an economic event, or some kind of act of God or whatever, which causes problems for the company, and the stock price would respond by not completing the target. Here's an active cup and handle pattern for Amazon. And if you look at this, let me just shrink this thing down so that you can see the full length out here. So this is a cup and handle pattern formed over a long period of time. And this is for Amazon. This was the lowest point. So we draw a line, replicate this line, same length, and place it on top of the neckline. So I have a price target of 203.98 for Amazon. Now it's marching on its way up there. Will it happen? I don't know, but it's likely to happen, more likely than not that we'll touch that target. It will take a little time, but it's going to happen. So that's the way we use cup and handle patterns. Now here's an example of a bullish pennant. We are looking at Microsoft Corporation, and we had a bull channel going up, and then it started consolidating sideways. So we drew a line of resistance on the top. Right now it's marked green because it's a support, but earlier it was a red line marking resistance, and we connected the candles on the bottom, and we created this line of support, which was a green line. But we broke out on the upper side as expected on the bullish pennant, and we got challenged by this resistance out here at 421.08. But right now we are still above the bullish pennant. So this is what a bullish pennant looks like. It's always on a bull channel, and it's a consolidation sideways with lower highs and higher lows, and then it breaks out on the upper side. So that's an example of the bullish pennant. Well, I promise I'll keep these videos simple and limited concepts, under 10 minutes. So I think that's all for today. Today what we learned was how to identify a cup and handle pattern. What does the cup look like? How do you draw the cup? How do you draw the neckline? Then we looked at the handle that has to be formed, and the price should start moving up after a dip. That's the handle. And then we saw how we can do the price target. So you connect the lowest price point within the formation, draw the line all the way up to the neckline, copy the line of the same length and place it on top of the neckline, and the top end of that line will show you the price target for that cup and handle pattern. We also said that cup and handle pattern may or may not materialize. One of the reasons why it may not materialize is because anything could happen in the economy. It could be a geopolitical event, or it could be a government policy or Fed policy. Something that is not conducive for the company can derail a cup and handle pattern. We also said that the cup should be formed over a period of time, which is counted in terms of weeks, not a few days. So you need at least 1+ week of data in order for the cup to form, and then you are likely to get more of a result. So we spoke about those things, and then we also saw what is called as a bullish pennant. So we already know what a bull channel is. So if you have a bull channel and then you have a consolidation at the top of the bull channel where the lower highs happen and higher lows happen, so it creates a pennant or a triangle formation. And typically in those situations, the price breaks on upwards, breaks out on the upper side of the triangle and starts proceeding up further. So it's basically a bit of consolidation before proceeding further on a bull channel. That is most likely to happen in most cases of the bull channels. But as I said earlier, friends, technical analysis is just one dimension. There are other aspects which drive the share price. So don't rely just on technical analysis. And even if you're doing technical analysis, don't just rely on the bullish pennant or the cup and handle pattern. Also look at the RSI. Is the RSI looking weak? Is the momentum looking weak? If RSI and momentum are looking weak, the chances of your cup and handle pattern materializing is very low. So those kind of things you also have to look within technical analysis. But overall, fundamental analysis and technical analysis go hand in hand in order to have a better chance of predicting the trajectory of the company's share prices going forward. In the long run, really good companies always do well. You can just buy it, forget it, switch out all the noise, look at it after 5 years, it would have gained 100 or 200% in value. But if the company is not very sound, then you'll feel a lot of volatility. And I think that technical analysis is more important for a short-term trader. For a long-term trader, it generally doesn't matter unless you are very particular that you want to buy at the bottom and hold for a long period of time. So in that case, you can try to see if the market is in a situation where it's going to fall after you buy, or it's in a situation where it's going to go up after you buy. No harm in that. So with that, my friends, I would like to bring to end this episode of technical analysis. In the next one, I'm going to go back into the basics, and I'm going to talk about exponential and simple moving averages and how to use them. With that, my friends, I'd like to bring this video to an end. I hope you liked it, and I'll catch up with you in the next session. Bye for now. Thanks a lot.